Hi everybody, it's Friday. We're talking markets with Jim Cramer on the floor of the New York Stock Exchange. All right, Jim, let's wrap up the week. The Dow recovering two-thirds of the losses here.
Look, I think now people are going to question. I was talking with my friend Jim Stewart, Pulitzer Prize winner. We were talking about the notion that is it healthy that it goes right back up? And what he was saying was, now people say, well, what the hell is that about? That's a negative question. We don't want what the hell is that about. We want people to just say, okay, so it had a correction, it's working way back over time. But the fact that it's working way back instantly makes you feel like it's phony. And a phony market does not attract new money. A phony market has money going out. And I think this was another one of these events, like the flash crash, where there'll be much less money in the market. You'll see waves of money coming out. And that's because individuals repeatedly recognize it's not an asset class, it's a dice roll.
Yeah, so have we blown out those short volatility people?
Yeah, they're done. Huh. They're done. There will be people who say they're not done, and there's great supporters of these products, but the individuals who did it, we were talking to Harvey Pitt, a former SEC commissioner, the individuals got in and they got destroyed. I think they'll say, well, what is this? And my goal is to try to make it so that the public policy is to get people to invest over time, because it's great wealth class. It's created tremendous wealth, and what happened is I think that once again we made stocks not credible as an asset class, and we also those who there was someone this morning. I was saying the volatility was viewed as an asset class, and it's not. And someone just was saying, Jim, you don't know what you're talking about. This is obviously an asset class, and I just wrote, you're funny.
It's not even worth responding.
Well, I like to do it just to kind of, frankly, point out that a point of view is not necessarily a correct point of view.
Yeah. Well said. Meanwhile, Jim, Coca Cola earnings 6% organic growth.
You know, look, I like PepsiCo. You know, fractional alerts. I think I like Frito-Lay. They have much better growth, but James Quincy is doing some great things. I always feel bad. Muhtar Kent gave him that hand. They did the refranchising. They've got some miniaturization. They've got, like when you go in your supermarket, you see the smaller cans. But I think James is going to do a good job. I did point out that Brazil's turning 6% is big. Digitization is the theme there. It made it so that the much more boots on the ground people can make decisions rather than have it be centralized in Atlanta. I really like the story, but it is more expensive than PepsiCo, and that doesn't make sense to me.
So Coke and Pepsi still doing well, similar to Boeing and Airbus in your view?
David asked me that, and I would say that Boeing and Airbus have tremendous demand. Carbonated soda does not have tremendous demand.
We also had Kraft Heinz report earnings. I mean, what a mess there.
Yeah, they have no growth, and actually, it's not growth. They are in retreat, and no one wants to own a company that is actually having sales that are down. Somewhat, by the way, our friend Mark Chaikin, we do things with. Shake Shack's guided sales to be flat, same-store sales, with a menu increase. So therefore, in a way, that's down. But the Kraft Heinz is a company in great crisis, and they have to buy someone. There is no need in your portfolio. We own Kraft Heinz for an acquisition, and we sold it in the 90s and the 80s because they went after Unilever. But Unilever became hostile, and Paul Pullman fought that. Great CEO of Unilever. So I don't know if I worked there. I don't know what I would do. This is a company that is in decline. And that's not palatable to investors. And they've already taken out, what, $1.7 billion in cost cuts last year? Doesn't matter. Yeah. You got to have growth. Every company, if your company doesn't have growth, then the company is doomed to oblivion. And that's just the way the stock market works. And I'm not going to disagree with it. You know, we had Martin Franklin on this broadcast a couple days ago. Yeah, that was a fun time. Newell Brands reported this morning. Yeah, Newell. They didn't disappoint from their previous outlook, which is really a big change for them. But when you go over the line items, you'll see that the Newell Brands pre-Jarden acquisition, their brands were uniquely weak. Also, they had some raw costs because resin went up, the transportation costs. But we got out of Newell literally twice of where it is. At least for our first tranche, and then we got rid of it in the 40s. And it would have been Allergan-like had we held it. Allergan meaning really terrible. I've gone beating myself up for Allergan Anderson, but Newell is a dangerous story, I think, because you're in there to try to bet that Martin Franklin can shake it up. And I think Martin can, but right now the numbers aren't good.
All right, Jim, we'll leave it there. There are many more stocks we're going to talk about. Everyone, please join us on actionalertsplus.com.